Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time, and this week's topic, guys, is on trading in multiple time frames. This is going to be a good lecture today, not just for intraday traders, but also for swing and core traders, okay? We're going to talk a little bit about how you can combine your intraday trading with your swing trading and vice versa, how you can combine your swing trading with your intraday trading to ultimately supercharge your trading and become a much better trader. And what's beautiful about what we're going to talk about today is that it lowers the risk. You're actually going to be able to supercharge your trading, but have lower or less risk exposure, which is incredible. You don't often get to do that, but with the topic today, that's what's going to happen, okay? So multiple time frames, how they're important, why they're important, and why many of you aren't using it. A lot of it is maybe you're a little scared, maybe it's laziness. So a couple things you're going to need to do, which you're going to see in today's lecture, is keep a carryover list from yesterday's gap list or yesterday's watch list. Many of you just delete the watch list. You just delete the gap list. And many of those stocks, the next day they run. And you're like, oh, I had it on my list yesterday, but I forgot about it today. Also, you want to have a universe of stocks, 300, 400, 500 stocks that you scan at least twice a week for daily charts, because not every great trade is a gapper, right? Sometimes they're just breaking from daily buy setups or breakouts or parabolics, but they're not on your gap list, okay? And that's very, very important, all right? So that's what we're gonna talk about today, guys. It's a very important topic. It's a good way to supercharge your trading. It's a good way just to become a better trader, whether you're an intraday trader, a swing trader, or a core trader. As always, guys, if you like this video, please subscribe. If you like the video, click the like button. And also, don't forget to turn on your notifications. Don't forget to turn on those notifications. I'm Jared Wesley of Live Traders. Let's get to it. This week's topic is the power of multiple time frame trading. And I think it's an appropriate topic because I'm seeing a lot of traders just not look at time frames above or time frames below. But what we're going to do today is something a little bit more unique with regard to multiple time frames. We're going to talk about actually truly matching time frames. See, it's one thing, for example, to have a bullish daily time frame and then a bullish 5-minute. But what if we had a really great pattern on the daily and a really great pattern on the 1-minute, 2-minute, 5-minute, 15-minute, something like that? So we're going to talk a little bit about that and how you can best take advantage of that type or that style of trading. I think it's really, really appropriate, especially, and we'll delve into this just a little, not a lot, but a little bit today, especially for those of you who are swing traders. So we're going to talk a little bit about swing trading as well today. But before we do any of that, we have to, it's just like our moral obligation to talk about when will the insanity stop? When will this thing stop? This week I have a good one for you. I don't know, the last couple weeks were, I guess they're always good, but this week's I thought was more interesting than most. So some of you guys may have seen this one. Let's talk about it. This was on Market Watch, I don't know, a week ago, something like that. It's like trying to beat the casino. Rookie trader turns 15,000 into 1 million, then loses almost everything. You can't make this shit up. And this is going to the point, we'll talk about this person in just a second, but you know how a lot of you guys will make the comment, well, gosh, why didn't he stop when he was up $1 million? Why didn't he stop when he was up 500,000? Guys, that's how people get up this much money, by gambling. They don't have any objectivity. So when you're sitting there going, man, I mean, when he turned 15 into 100,000, why didn't he stop? Why didn't he at least protect his initial 15,000? How do you think he got from 15 to 100,000? How do you think he got from 100,000 to 1 million? By gambling. They don't think the same way you and I think. They are different and not in a good way. Okay, so that's how this happens. So this particular person, I think I could be wrong on this. Maybe he was using Robinhood. Yeah, it is. There it is, using Robinhood. But anyway, he started out funding his account with $15,000. Wait for it, in credit card advances. Yep, I'm going to read that line again. He started out funding his trading account with $15,000 in credit card advances. I don't even know what to say. Yeah, 19.97%. That's fantastic. I mean, I shouldn't be laughing at this, but this is how insane this is. And yet, this person was playing the victim. Okay? I mean, they make it so easy that you don't have to know anything about stocks, and then you go there and you start losing money. So they're blaming the brokerage houses for making it, quote, too easy to sign up to be a trader. Wow. When's the last time you heard somebody say, oh, it was too easy to do that? Not very often, right? So this person's blaming them. Long story short, they went from 15 to a million, and a million back down to $6,956. Wow. And this is bad because it's not really 15,000 when you think about it. 15,000 in credit card advances, then took out another two. You heard me, two $30,000 home equity loans. So this person basically had $75,000 of money, right? Two $30,000 equity loans, and then $15,000 in credit card, and then now they're down to $6,900. We have some fun with this stuff. We joke, we laugh. This is really serious stuff, guys. All right, I put these, when will the insanity stop, in here every week so you guys can understand people are continuing to do this and they will always do this. You just don't want to be one of them. You don't want to ever be featured on this segment every week, okay? So this one I thought was just wow. I mean, obviously it was. MarketWatch covered it, which, they don't cover most of these. So anyway, that's this week's When Will the Insanity Stop? And it's time to move on, guys. Use your stop losses. Take your stop losses. Use good money management. It takes common sense and objectivity to be successful in this world. And I know that's why so few people are successful, because they lack common sense and objectivity. And the crazy part is the people that lack common sense are the same people that think they have it. That's what's crazy about this world. All right, let's move on. So, multiple time frame trading. I think this is one of the more or most misunderstood topics in trading, but yet it's one of the most important topics in trading. And you'll be happy to know there are nothing but chart slides today. Nothing, except for the very last slide. There's all and only chart slides there, which I know it makes you guys happy. So multiple time frame trading, guys, does many things for you. It helps you get into trades earlier, helps you stay out of trades, helps you figure out where your target should be, helps you figure out, wink, wink, swing trading, if you should hold that stock overnight, maybe for a multiple day move or a multi-week move. But many of you are just, I think it's perhaps because of FOMO, I'm not really sure, but many of you are just so caught up in wanting to get into the trade that you don't look around you. And I used this analogy before, so it's a replay of an analogy, but it's like looking at the forest from above, right? You're so focused on the leaves and the bark or the branches of the trees that you're not looking at, wow, the forest around me is burning down, and I didn't recognize it because my face was so caught up in this leaf or this piece of bark. That's what multiple time frame trading does for you. But today we're going to put just a slightly different twist on it, okay? So first one. Now you take a look at this, and this is XPEV from not very long ago. I think 3 days ago. I think it was last Friday. But anyway, XPEV, maybe it was Monday or Tuesday. I don't remember. But this is a chart of a stock where it was, hanging around, not doing a whole lot over here on the left, and then it just ripped, moved up, pulled back, moved up, pulled back, moved up, pulled back, and just ripped, okay? And then you get this wide range green igniting bar, and it's taking out this resistance to the left, okay? And this is a day that perhaps a lot of people traded this stock because it moved up quite a bit. But then we go lower high, lower high, lower high, little bottoming tail. What happens ultimately here is many people trade a stock, and that's it for the stock. I mean, that is it for the stock. You don't ever look at it again. You don't put it on a carry over list, hint, hint. You don't put it on any other watch list. Some of the best trades that you take will be stocks from yesterday that did not perform. I'm going to repeat it because I think it bears repeating. Some of the best gappers, daily charts, whatever, some of the best stocks you will trade are stocks from yesterday that didn't perform perhaps in the manner you thought they would. Or maybe they did and they still left a little on the table. Okay? So many of you don't even look at yesterday's trades. And some of you will ask me, where'd you get that idea? 80% of the time that idea came from yesterday's list or yesterday's trades. It's what I call a carryover list. Okay? The other 20, 30% come from the chat room and other areas, right? So this is a good example of a stock that what? Had a daily 3-bar play. Wide bar, narrow bar, and you're like, ooh, that's a sweet daily 3-bar play. And then red bar, and you're like, it's junk. I'm not watching that stock again. And you're like, well, why not? Is it over now? I mean, if the stock pulled back to $30, I might have a different opinion of it. But it had a wide range igniting bar that took out resistance, followed by a narrow range resting bar, which gives you a 3-bar play. And then it just happened to pull back 2 more days. So instead of you guys thinking, well, maybe it might form a buy setup on a 50% retracement. No, it's junk. I'm not going to look at that thing again. Why? Right? So it's a good idea to keep a carryover list from previous day's trades. Now, again, sometimes some of those stocks won't make the carryover list. They'll be so damaged or so bad that they wouldn't make the carryover list. But a lot of times they will. So have a separate radar screen or a separate symbol list where you have a carryover list from previous day's trades. So long story short, this 3-bar play didn't trigger. It continued to pull back. It's got a daily buy setup. Now tell me what you think about why you should or shouldn't have had this on your list. Because now the daily buy setup triggers. And in this case, it does gap up a little bit, so you probably wouldn't have missed this one. So this is an example of one where perhaps you would not have missed just because, well, it gapped up over a red bar, and in your morning watch list, you probably would have caught that. That's good, but that's not always how they happen, and I'm going to show you that in a couple of minutes. So here's an example of a stock where if you wanted to play this as a swing trade, and you're going to see what the theme is here today. If you wanted to play this as a swing trade, you could have just bought $50 at the open and used this area down here at like $48 as your stop loss, right? You could have done that. And your first target would have been up here at like 54, and then your second target way up here at like 75. That's fine. That's a swing trade. Nothing wrong with it. But what if we use this as a gapping stock, which we frequently do, okay, and we drilled down, and this happened. Same exact daily chart. Nothing has changed. But now instead of just buying at $50, we actually have a pattern. Now, I'm going to get to this a little bit later on in more detail, but what does this do for us? I want you to really give it some thought for a second. So again, I can look at the daily chart, and I can go, I'm going to buy it at 50 because it's triggering a daily buy setup. Yep, I'm going to pay up a little bit for it, right? Because the actual trigger is probably $49.50 on the buy setup. But it opens at 50, I'm going to pay up there. All right, maybe a little under $50, okay? And now my stop loss has to be under this bottoming tail on the daily. I don't have a choice. I'm swing trading it. But what if, for those of you who do both intraday trade and swing trade, what if you could have taken the exact same concept you did, bought a few shares at 50 as a swing trade with like a $2 stop loss or a $1.50 stop loss or whatever it was. So buy a few shares there as a swing idea. And then on a 2-minute chart, you see this, wide bar, narrow bar, rip, pull back, rip. Now what? And you can see over here, you can barely see it. It closed the day, or this isn't the end of the day, but it closed the day pretty high up there, almost near $54. So now you can get an entry here at like $51.30, stop loss at $50.50, 80-cent stop loss instead of a $2 stop loss. And you get to the advantages of making this money for a stock that ripped and closed, and this is important, closed the day strong, right? It'd be different if this stock closed the day at $50. I probably wouldn't hold it as a swing trade. But if you can get in here on a 2-minute 3-bar play, after a daily buy setup, so again, nibble some at 50 for your swing trade, right? $2 stop loss, nibble some at 50. You see this happen, you're like, sweet, I'm going to add to my position. Sure, it's going to raise my cost average a little, but you know what it's also going to do? Raise my stop up. Huge. My stop is now either going to be $49.75 low of the day or $50.50, right? So you could do both. You could do part of your shares at $49.75, that's your swing lot, and the other part of your shares at $50.50. Now, this only happens because of multiple time frame trading, right? You have a daily stock that looks to be transitioning back up, has a daily buy setup, and inside of the daily buy setup, you get a 3-bar play. And you also get a buy setup over here. This is perfect trading. and then you hold some overnight, but you're already $3 or $4 in the money. And this is the key, you've already cashed out 3/4 of your position, half of your position. You can't lose anymore, right? So not only do you have a good cost average with a good stop loss, you've already gained $4 on it, sold some of your shares, made some money, maybe made 2R on it, whatever, and now you still have a half lot left for that bigger move back to 70. Let's try it again. Okay. Here is IDEX, again, a very recent trade. And what do we have? A daily buy setup with an intraday buy setup. This is matching timeframes about as perfect as you can match them. So here's a stock, again, moved up huge up to 450, pulled back, bounced, pulled back, aggressive buy setup at $2. You could have taken it, but it was a little bit aggressive. But again, you probably could have taken it. Rips higher and pulls back. Now all of a sudden you have another buy setup at that like 280 area, give or take, somewhere around there. So you could buy it as a swing trade. Put your stop right here where this pink line is, somewhere around, I don't know, 275. So it's only like a 15-cent stop loss, okay? And your target's back up here near $4. And you can do that. Nothing wrong with it. And you would buy it off the open right there. As soon as it breaks that 290 area right here, whatever that area is, 295, buy the stock. There's no pattern there. But the reason you're buying is because of the daily pattern. You're buying this on a daily buy setup. And you don't yet know if it's going to give you the 5-minute buy setup because it hasn't happened yet. So you're going to enter the position as a swing trade, initially as a swing trade. And then you're going to say, okay, if it gives me an alternate entry, I'm going to add to my position. Well, it does exactly that. And on a 5-minute chart, right around 10 a.m., give or take 10:10, this thing pulls back, lower highs, lower highs, lower highs, lower lows, gives you an entry here at like 295 with a stop at 290. Wow. I can back the truck up with shares because now you only have a 5 or 6 cent stop loss. And this thing ultimately does what? Goes up 30 cents. Now you're going, oh, that's not very much. Guys, it's a $2 stock, $3 stock. It's a 5-cent stop loss. It went up 6 to 1, 5 to 1, call it 5 to 1. So now what do? Dump a lot of the shares here, right? Up here in the 310, 320 area. So maybe you bought 10,000 shares of this thing because you had a $500 risk. Well, maybe sell 5,000 of those shares for the 30-cent gain, whatever it is, okay? And make yourself $1,500 on it, 3R. Then hold 5,000 shares for the swing trade. And if this thing happens to go from $3 to $4, you just made $5,000 or 10R. And the beauty of it is, if the stock closes strong, there's no risk left. This is the part I need you guys to understand. If everything happens the way you'd want it to happen or the way it should happen, you have no risk on your swing trade anymore because you've already locked in $1,500. So you already have $1,500 of, quote, padding, all right? Your cost average in this case is the same as the daily buy setup, as the 5-minute buy setup. It's going to be almost identical, give or take a couple pennies. You can use low of the day as the stop, or you can use 290 as the stop because it closed all the way up here. So you already have 40 cents of protection. So now all of a sudden, you have a really favorable cost average. You have a relatively tight stop loss. And if it came back and tagged you, what happens if you lose 10 cents on 5,000 shares? You lose $500. But you already made $1,500. So you're netting $1,000, and that's if it doesn't work. What if it works and goes to $4? Now you've made $5,000 more, plus your $1,500. You made $6,500. And what did you really risk? $500. And that $500 risk only lasted for about 10 minutes because this thing started to move immediately. Many of you just aren't doing this with your trading because you're not paying close enough attention to daily charts. You're simply only ever looking at gappers. You don't have a carryover list. You don't have a universe of daily charts. 500 daily charts that you review once a week or so. So this is a great way to combine your trading. So again, wide bar takes out a red bar pivot, narrow bar, and then what do we have? From the blue line all the way to the pink line. So we have somewhere around, I don't know, $62 up to $70. You have $8 worth of room here. And that has to be your target on OSTK. This has to be because that's a double top. There's a pivot here, pivot here, pivot here. But that doesn't mean this can't be a very effective trade. So you could buy it at $62 and put your stop way down here at like 57. It's a $5 stop. Your risk to reward on the swing trade's not great, but you get an opportunity over here to take a 15-minute 3-bar play or a little 5-minute breakout with a buy setup. Now all of a sudden what was looking like not a great swing trade is turning into a really good swing trade. Why? Because I don't have a stop loss at $57 anymore. I have a stop loss above 62. Okay? 62. Think about what I just said. It's very important. You get in at 62, give or take, on the swing entry, knowing you only have a 1-to-1 risk reward, but you're hopeful that you're going to find some form of intraday pattern that you could add to. So you buy at 62, your stop's at 57, $5. So maybe in this case, you have $500 risk again. You buy 100 shares, $500. But now over here, you're going, oh, look at this, 63.50 entry, 62.25 stop, $1.25 stop. Now all of a sudden, you can add a lot more shares, right? Maybe you can add 300 or 400 more shares, 3 times, 4 times more shares. Your cost average is actually going to get a little better because you already own 100 at 62. But the beauty of this isn't the entry cost average. The beauty of this is the raised stop loss. So now the raised stop loss is going to be roughly $62. Guess what your cost average is now? Maybe 63, 63.25. So instead of having $5 of exposure, you have $1 exposure. Now what happens if it reaches $70? It's a 7R move. What was a 1.5R move, right? You had an $8 range, 62 to 70. You had a $5 stop. That's 1.6R. But by adding to this trade, not only do you get to sell some on the way up because it moved $4, pocket some money, protect yourself, you get to raise your stop loss to 62 and your cost average is 63. So now all of a sudden you have 500 shares, perhaps you sell half of them, 250 of them, and you go out there and you make $4 on 250 shares and you make what? $1,000. So now you have 1,000 in the bank, 2R. You still have 250 shares left. So what's your risk exposure? $250. If it stops out at 62, you'll lose $1 on 250 shares, and that's $250. But you already made 1,000. So worst you're going to do is make 750. But what if it goes to 70? Now I get to ride 250 more shares up for a $7 move. It's $1,750. Plus the 1,000 you already made is $2,750. Now you end up making 5.5R on this trade. On a trade that only had 1.6R in potential, now it all of a sudden has 5.5R potential. And the best part is you're protected at the end of the day when this thing closes the day at $66 or $67. That's the beauty. I don't want to call it free money, but it's almost free money. Okay? What was going to be a mediocre trade could now potentially be a fantastic trade. Okay? Let's do it again. Here's another example. What do we have? A stock that's kind of chopping along, wide range bar comes in, chops along, breaks out, chops along, and then we get a wide range bar, takes out the topping tail. 2-3-day consolidation right here. So we had basically a 3-bar play. A little bit off, right? Bar number 2 is a little higher than bar number 1, but basically a 3-day consolidation. Many of you wouldn't have had this on your list. Or if you didn't catch it on the gap list, you would have missed it. Because this is not really a gap. It is a small gap. You can see that right there. It's a small gap, but it's more like a daily breakout or a daily kind of a 5-bar play. All right? So if you see a stock like this in your, say you're scanning, you're doing your weekly scan, which you should do twice a week, okay? And you're seeing a wide range bar with a red bar, like, wow, I need to put this on my list. And then if you're lucky, maybe it pops up on your gap list. But otherwise, you should be looking at it every morning. Just quickly run through those 300, 400, 500 stocks, see what they're up to. It doesn't take very long, 5-10 minutes. And also, whoa, this thing's pretty nice. If I go back down to the 15-minute, look at this area at 355. Pivot. If I can get over 355, man, this thing's got copious amounts of room to go higher. So you could buy it as a daily breakout at 355 with a stop down here at like 325. So you have a 30-cent stop loss on the daily breakout. That's your swing trade. 30-cent stop, which is tight. Breaks out, you buy it at 355. You got a 30-cent stop at 325. Okay? So far, so good. Pops up to 385, pulls back and gives you this gem. Right around 365. What a gem. So you buy it. Your cost average is going to be above 360 or above 360 because, well, your swing trade entry is going to have a lot fewer shares than your intraday entry, right? So you have like a nickel stop loss here. Less probably, but let's call it a nickel. You go buy 10,000 shares of it. So on the swing trade, you're doing $500 risk. You bought 15, 16, 1,700 shares of it, right? 30-cent stop times 1,700 shares is $510. So you already own 1,700 shares at 355. You buy 10,000 shares of this thing at 365. Your cost average will end up being like 363. But your stop loss now is no longer 325. It's now 360. All of a sudden, you're only risking 3 cents. So you've actually lowered your risk. Yeah, you might have 11, 12,000 shares of this, but you only have a 3-cent stop loss now. 360 versus $500 risk. This thing rips higher. And yes, I know it sounds crazy to say rips, but it went 30 cents. 30 cents on a nickel stop loss. 6 to 1. When you have 11, 12,000, almost 12,000 shares of this, you're up $7,000. Just think about what I just said. You're up $7,000. You're up 10, 12R. And if it closes strong, you can hold it for a swing trade. In this case, it pulled all the way back to your entry, and let's see if it pivots later. If it doesn't, then you probably sell, half your shares up here, maybe 3/4 of your shares up here at 390. Make some money. Put some money in the bank, right? And then, if it closes strong or you feel comfortable with how it's closing, hold 3,000 or 4,000 shares. Isn't it the beauty? You only started with 1,700. So now you put $1,000 or $2,000 in the bank, and you're able to hold twice as many shares for your swing trade, or more. Okay? Your risk ends up being 3 cents, and you might hold, say, 3,000 or 4,000 shares. Now you're only risking $150, and you already pocketed 1,000 or 2,000. It's a free trade. It's free money. How many of you are doing it? Not that many. Here's another example. Here's a stock that, again, on your daily watch list, should be on your watch list because it's a stock that moves up, consolidates out for 2-3 weeks, and then rips. This is a beautiful breakout trade at $40. This is one we could start at $48 on the breakout with a stop loss down here at like 46. 48 by 46. You could start it over here. So swing trade this at 48 by 46. Okay? Then it rips up to 50. Then it consolidates again and gaps up this time. So now you could add on the gap up, $51 or $52, whatever it is, and you can see it over here, 50.25. All right, so it gaps up to 50.25. So now add to your position, add a full lot. Now your cost average is 49, but guess what your new stop loss is? 49. Okay? Think about it for a second. 48 entry, 46 stop loss, $2 stop loss, $500 risk, 250 shares. $50 comes along, it gaps up. You're going to add a 50.25. You're going to add a full lot. You're going to have 250 more shares. Now you have 500 shares. Cost average is going to be roughly 49, like 49.07. Okay? Your stop loss is 49. It's a free trade. Think about it. Twice as many shares. 500 instead of 250. And then, boom, the stock rips to 51.25. You're already up $2 now. Right? You're up over $2 on twice as many shares. And here's the beauty. It pulls back and boom, the magic happens. You can add right here at 50.84 and raise your stop to either 50.73 or 50.30. Wow. Think about that. So now you have a cost average of $49, 500 shares. But now you're going to take this as an intraday trade at 50.84 with what? An 11-cent stop loss. All right? I think this is a little bit higher than that. It might be like 50, 70. You might call it a 15-cent stop loss. Okay? 15-cent stop loss. So now, because of the 15-cent stop loss, just on that trade alone, you're able to buy 3,300 shares. Just on that trade alone. And you already own 500. So your new cost average is going to be somewhere in the high 49s, 49.80, something like that. Okay? And this stock does what? Rips higher all the way up to 52 bucks. Wow. So on a 15-cent stop, the stock goes $1.30, 8R, 9R. More than that because you own it at better than 50.84. Right? You own it at better than 50.84. So what are your choices here? Simple. You got three of them. You can trade this as a swing trade by itself. You can trade this as an intraday trade by itself. Well, what about an intraday swing? What about taking full advantage and full opportunity of this trade? Started as a swing trade at 48, add at 50. Even if you missed 48, buy it as a swing trade at 50.25 right off the open. Use 49 as your stop loss, $1.25 stop. Add back right here. So boom, I'm taking advantage of the swing trade, I'm taking advantage of the day trade, and I'm holding some overnight. Wow, I get my cake and I get to eat it too with the cherry on top. And if this thing closes strong, hold it till it goes 54, 55 bucks. And you can't get hurt now because you've sold some of your shares in the money. You've made 2, 3, 4R. You've raised your stop loss to 50.30. And guess what? Your cost average is lower than 50.30. Your cost average is below 50.30 or right in that range. Because again, you bought some at 48, you bought some at 50, you averaged $49, and you're going to add a bunch here. It's a free trade. You could have even added more right here. So stop thinking so singularly. Think about, if you're a swing trader and you have some time to intraday trade, how you can supercharge your swing trades. If you're an intraday trader and you want to learn to swing trade, think about how you can supercharge your swing trading. See what I'm getting at? And these opportunities are out there, right? These opportunities are out there for people. But most of you, if we're being honest, are two things. Either too lazy to do a carryover list or a personal stock universe, or I'm sorry to use this word, but you're too chicken shit to actually take the trade. You're too scared. You're like, well, I am in my swing trade at 50 and I don't want to ruin it. You know, it's looking really good. If I add at 50.84 and it doesn't work and it's going to ruin my... Guys, they're not all going to work. But when they do, you're going to get 3 or 4 times more profit than you normally would have. Okay? And it benefits your intraday trading and it benefits your swing trading. Okay? It's a win-win situation. And then I just thought I would just show this from yesterday because Unmol did such a great job. 3-bar play rip, 3-bar play rip. A little bit more of an aggressive buy setup that he got in late. It's looking more like a 1-minute buy setup. Okay? And then this one ripped. You guys actually, the best pattern here was actually this buy setup here at 402. Right there. Unmol got in a little bit earlier than that, but my goodness. 10 grand. Right? He made 8 or 9,000 on those stocks. Then he's got some, look at this, 11,000 unrealized. It's up $21,000 yesterday. Impressive. Textbook pattern, a little bit of an aggressive pattern. Could you have held some of those overnight? Sure you could have. Guild would have been tough just because it ripped like 10 to 1. But yeah, maybe you hold some of those. Maybe you hold a quarter. Okay? Maybe you hold an eighth. Whatever you feel comfortable with holding. Okay? Now, that's mostly today's lecture, but I wanted to show one more slide today. Okay? One more slide today. And this slide is to hopefully help you stay realistic. It's not rubbing anything in. It's not, I can't use the other of that. It's just to wake you up. Open your eyes a little bit. Okay? Open your eyes a little bit. And that's what this next slide is all about. And the reason I put it in here is because I'm in the process of making a wealth building seminar at the moment. And I do a lot of research and stuff like that to do that. And I came across this and I thought, interesting. I wanted to show this to you so that you guys would stop trying to be unrealistic with your trading. Now, granted, this is from 2014. So obviously the numbers are slightly higher now 6 years later. Okay. This doesn't necessarily have anything to do with trading, but I'm showing it to you so that people will stop, for God's sake, stop coming into this business thinking they're going to get rich quick. The one thing I did not add to this is how long it takes people to get there. I have another slide for that you'll have to, take the course to see that. Okay. But how long it takes people to get into the top 1%, how long it takes them to get into the top 0.1%, 1/10 of 1%. So let's just go over this briefly, okay? If you are between 27 and 31 years old, okay, $160,000, and again, this is 2014, could be slightly higher, $170,000, you heard me, gets you into the top 1% in the United States of America. Now, obviously, if you live in San Francisco, that number could be higher. If you live in Mississippi, that number could be lower. Okay? This is across the country. So 170 grand, okay? This is income. This is not net worth. This is income, okay? So at 27 to 31 years old, if you make 170 grand, you're in the top 1% for your age bracket. If you make 250, I think it's actually 300,000. If you make $300,000, you're in the top 1/10 of 1%. 1/10 of 1%. If you make $300,000 a year in your late 20s, early 30s. Okay? So if you take a look at this, now again, these numbers are a little higher now. I think it's over 400,000 these days, okay, for the top 1% overall in the country. I'm showing this to you again as a little reality check. So many people come into this business and they watch a ridiculous Facebook ad, Google ad, Twitter comment, or something like this. And they're like, oh, I'm 21 years old. I want to make $500,000 next year. That would put you in an unbelievably small category. Okay, an unbelievably small category. All right? So 1/10 of 1% is 300 grand at 27 to 30. 1/10 of 1% is about 550 grand if you're in your early 30s, 32 to 36. 1/10, not 1%, 1/10 of 1% is 1.2 million, I think, if you're 42 to 46. Okay? And then the highest bracket is 47 to 51, is like 1.5 million. That's 1/10 of 1%, not 1%, 1/10 of 1%. Okay? So I'm not going to spend much more time on this. I put this up here to give you guys a little slap of cold water. Okay, the ice bucket challenge. You're doing really well if you're making $100,000 to $300,000 a year at any age in your life. At any age in your life. So stop coming into trading and thinking in 6 or 12 or 18 months that you're going to set the world on fire just because you were previously successful in a different career. This is not that career. It's different. Okay? And the last thing I wanted to comment on, because I just thought he deserves the accolades. Guys, I'm almost 28 years old. And he's above anyone on this chart. He'd be in the top 1/10 of 1% if he was 50. Think about what I just said. He's 28. He's probably in the 1/1000th of 1%. Not even 1/100th, probably 1/1000th of 1%. Why am I saying this to you? To show you how impressive what he's done is. But to show you it can be accomplished. The kid does 3R all or nothing and sits back and smokes a bowl. Right? Seriously, think about it. He'll be 29 this year, Corey. He reminds me all the time. He's like one of those kids that's 8 years old. He's like, no, I'm like 28 and a half, man. Seriously, he does that sometimes. I'm almost 29. Anyway, okay? Think about what I just said. So it's twofold. It's one to say, wow, that's impressive. And it's two to say, but look how simplistically he's getting it done. Now, granted, it's through not just trading, through other endeavors. But wow. 3R all or nothing. picking good trades, sitting back, and letting your management pay you. Not putting your personal subjective twist on it. Just let your management pay you. Sometimes you go through a lumpy streak, and other times you go through just an unbelievable streak. Like you guys recently did 17R in 2 days, 17 grand in 2 days. Insane. So I just wanted you guys to see that so you have a little bit of a reality check. Okay? To see what puts you in the top 1% or top 1/10 of 1%. All right? So I hope you guys learned a little bit in today's lecture. I hope you learned a bit about multiple time frames and how you could supercharge your trades, make those intraday trades better, make the swing trades better. But realistically, big picture, you should always have a carryover list. You should always have a daily watch list, and you shouldn't just ignore those ideas that you traded yesterday or didn't trade yesterday. Usually or frequently the next day, they'll end up working, and you're like, oh man, I missed that because I wasn't paying attention. It was on there yesterday, but I forgot about it today. All right, so I hope you guys learned a little bit about that. I'm Jared Wesley. We'll get back at it again next week.